Look at this chart. We see a smooth, continuous trend right up until Friday's close. But then Monday morning hits, and the price jumps entirely, leaving this massive empty space. Most amateur traders see that blank space and panic. The fear of missing out kicks in, and they rush into a trade under the flawed assumption that every gap must immediately snap back to fill the void. That impulse gets punished fast. The moment the market opens, broker spreads, the built-in fee you pay to enter a trade, widen drastically, and extreme price swings can instantly trigger a loss. To understand why this happens, look at the mechanics. The retail Forex market goes to sleep for 48 hours over the weekend, but the rest of the world keeps moving. During that downtime, central banks make surprise announcements, geopolitical conflicts escalate, and sudden election results roll in. When the market finally reopens, it has to instantly price in 2 full days of missing data. Once you recognize that a gap is just delayed information, you can turn a terrifying price jump into a predictable setup. The timeline starts at minute 0, Sunday evening in most time zones, the exact second the trading week goes live. At this precise moment, global liquidity is incredibly thin. Buyers and sellers are still waking up, causing wild price fluctuations and making your broker's spreads completely unreliable. This brings us to the golden rule of the timeline. Do not trade the open. You have to wait for the initial chaos to subside. Use this waiting period to diagnose the gap. You need to look at the technical context and identify exactly what type of price action you are dealing with. First, look at this common gap. The price jumps slightly upward without a major news catalyst, hits a thick ceiling of resistance, and starts to bounce downward. Because these lack real momentum, the price reverses, perfectly filling the empty space left on the chart. Now compare that to this chart, displaying a breakaway gap. Driven by a massive news event, the price plunges violently through a thick support level and keeps dropping, establishing a fresh trend. Taking the time to categorize the gap keeps you from trying to catch a falling knife. It filters out the opening bell noise and isolates true tradable signals. We advance the timeline to the 15 to 30-minute mark. Spreads have finally normalized, and the danger zone has passed. Take a look at this URR-USD chart. Over the weekend, the price gapped up and is now stalling right at a major daily resistance band. You don't enter just because it hit a line. You hunt for confluence, watching how newly forming candlesticks react to this level. We look for reversal shapes, like a doji. Here, a bearish pin bar forms, leaving a long upper wick that firmly rejects the resistance band. That distinct visual rejection confirms that sellers are stepping in and taking control of the market. Now, it's time to set the trap. By waiting for that localized candlestick confirmation, you transform a reckless Monday morning guess into a highly calculated entry. Here are the execution rules. You place your short trade and instantly set a strict, non-negotiable stop loss. Your stop loss goes logically just above the pin bar's wick. This protects capital while honoring the technical reason you entered. For take profit, aim for a conservative 50% partial close, or hold for a full 100% gap fill down to Friday's close. This systematic, timeline-based approach changes trading from a desperate weekend gamble into an exercise in applied statistics and patience. Successful DApp trading requires an intelligent, disciplined reaction to new data, not a prediction of the news. Open a demo account. Pull up 52 weekends of historical data and test this edge for yourself before risking real capital.